Today we will do an in-depth analysis of ICICI Bank Limited as of 3rd November 2025. Disclaimer, this video is for education and information only. It is not investment advice or a recommendation to buy, sell, or hold any security. I'm not a SEBI-registered advisor or research analyst. The video may contain errors or omissions. Please do your own research and consult a licensed professional before making any investment decisions. Views are informational. Past performance is not indicative of future results, and market conditions can change rapidly. Let's talk about what we're analyzing today. We are discussing ICICI Bank Limited, ticker ICICI Bank, on the National Stock Exchange of India, and 532174 on the Bombay Stock Exchange, as of 3rd of Nov 2025, time zone Asia, Kolkata. This review covers the last 3 fiscal years, FY 2023, FY 2024, FY 2025, and the trailing 12 months where relevant, plus stock price behavior over the last 12 months. Where data is not disclosed, I will say not disclosed, and explain how to approximate. Let's talk about what the company does. ICICI Bank is a large private sector bank headquartered in Mumbai. It operates a universal banking model serving retail, SME, and corporate customers. The bank offers savings and current accounts, term deposits, home, auto, personal and business loans, credit cards, trade finance, cash management, and treasury services. Through subsidiaries and associates, such as life and general insurance, an asset management company, and a brokerage. It also participates in insurance, mutual funds, and online securities distribution. The network spans thousands of domestic branches and multiple international locations, and the bank is designated a domestic systemically important bank, implying higher prudential buffers. Let's talk about the products. On the retail side, the bank offers deposit products, savings, current, fixed and recurring deposits, and lending products, home loans, vehicle loans, personal loans, credit cards, and gold loans. On the business and corporate side, it provides working capital lines, term loans, project finance, trade services, foreign exchange, and treasury solutions. Fee businesses include payments, cards, wealth management, and distribution of third-party products. Recent product initiatives include enhancements to co-branded credit cards and Forex card offerings, upgrades to outward remittance platforms, and a startup-focused banking proposition with bundled accounts and credit lines. Let's talk about the revenue mix. For a bank, top line is generally split between net interest income, interest earned on loans minus interest paid on deposits, and non-interest income, fees, commissions, treasury trading gains, and insurance-related income at the consolidated level. On a standalone bank basis in FY 2025, net interest income was roughly 812 billion and non-interest income around 266 billion, implying a mix near 75% NII and 25% non-interest. On a consolidated basis, where insurance premium inflows are included, both interest and non-interest contributions are larger. The presence of the insurance businesses increases the share of non-interest revenue. By operating segment, profit before tax in FY 2025 was broadly diversified across retail, wholesale, and treasury, each contributing a significant share, which helps reduce concentration risk. Let's talk about stock performance since listing. ICICI Bank listed in India in 1998 and has created significant long-term shareholder value. Adjusted for splits and bonuses, the stock has compounded at an approximate 22% CAGR over 27 years through 2025. Turning a modest late 1990s investment into a materially larger sum. Notable drawdowns included the global financial crisis of 2008, when shares fell more than 60% intra-year, and the COVID-19 shock in March 2020, when shares roughly halved before recovering. These episodes illustrate that while long-term returns have been strong, banking stocks can be volatile during systemic stress. Let's talk about revenue trends in the last 3 years. Consolidated total income rose from roughly 1.66 trillion in FY 2024 to about 1.92 trillion in FY 2025, up in the mid-teens, after a strong step-up in FY 2024 from FY 2023. Net interest income grew 9 to 10% in FY 2025, reflecting healthy loan growth but also higher deposit costs. Fee and other income grew faster, supported by payments, cards, distribution, and insurance subsidiaries. There was no year-over-year revenue decline in FY 2023, FY 2024, or FY 2025. The deceleration in FY 2025 growth versus FY 2024 was largely due to normalization in net interest margins as industry funding costs rose from FY 2023 into FY 2025. Let's talk about new products and services, expected mix, and guidance. Management's thrust is one bank, one team, prioritizing comprehensive customer coverage rather than a narrow product bet. Enhancements include refreshed Forex card propositions for corporates, new features in outward remittances, continued scaling of the co-branded Amazon Pay credit card, and broader digital ecosystem integrations. While the bank does not provide a formal revenue by product forecast, the direction is for fee income to grow alongside assets, supported by payments, cards, wealth, and distribution, with insurance subsidiaries also contributing to consolidated non-interest income. Qualitative guidance points to healthy, broad-based growth with no fixed loan mix targets. Let's talk about the order book or backlog. For banks, a traditional order book does not apply. The closest proxy is the pipeline of sanctioned but undispersed loans and the expected utilization of credit lines. The bank indicates adequate demand in retail mortgages and vehicles, stable SME demand, and a reasonable corporate pipeline, particularly as private sector capex and infrastructure spending improve. However, there is no disclosed numeric backlog. Hence, this item is not disclosed, and we infer prospects from loan growth commentary and sanction trends. Let's talk about why revenue would have dipped, if at all. There was no revenue dip in FY 2023-FY 2025. The pacing slowed in FY 2025 versus FY 2024 due to margin normalization as deposit rates rose and net interest margins edged down. That industry context explains why net interest income growth moderated even as loans grew. Let's talk about EBITDA, or operating profit, in the last 3 years. Banks don't report EBITDA the way industrials do. The closest proxy is operating profit, or pre-provision operating profit. On a consolidated basis, operating profit increased to approximately $778 billion in FY 2025 from around $641 billion in FY 2024, reflecting near 20% growth after a strong prior year as well. Cost to income improved from about 40% in FY 2024 to roughly 39% in FY 2025, pointing to operating leverage. There was no year-on-year decline in operating profit across these 3 years. Let's talk about why EBITDA would have dipped, if at all. There was no dip. Quarter-to-quarter treasury effects can move operating line items, but on a full-year basis, pre-provision operating profit rose each year, helped by scale and productivity. Let's talk about EBITDA margin in the last 3 years. Using operating profit divided by total income as a proxy, margin sat in the high 30s to around 40%. FY 2025 showed a stable to slightly lower ratio on a consolidated view due to insurance premium flows carrying lower operating margins, but the core bank's efficiency improved, evidenced by a lower cost-to-income ratio. Let's talk about why EBITDA margin would have dipped, if at all. Any small change was mix-driven. Higher insurance activity in consolidated numbers and investments in people and technology, rather than deterioration in core banking efficiency. The standalone bank's cost discipline and income growth offset most pressure. Let's talk about debt to equity and whether debt is high. A bank's balance sheet is funded mainly by customer deposits and wholesale borrowings, not corporate debt in the usual sense. As of March 2025, long-term borrowings were in the 2.2 trillion range against equity near the low 3 trillion range, implying a debt to equity below 1 times on that narrow definition. Total assets to equity, essentially leverage in a banking context, was around 6 to 7 times, consistent with prudential norms. Capital adequacy, including CET1 and Tier 1, remained comfortably above regulatory minimums. By sector standards, leverage is not high. Let's talk about cash flow conversion and how it compares. In FY 2025, reported net income of roughly $510 billion contrasted with negative operating cash flow as the bank expanded loans and investments, common in a credit upcycle. That makes accounting earnings to cash conversion look weak in a single year. In banking, negative operating cash flow often reflects asset growth rather than cash earnings quality issues. Versus some peers that reported positive operating cash in FY 2024, FY 2025, ICICI's FY 2025 conversion would be marked as weak on a simple ratio, but context matters. Growth lending consumes cash while creating earning assets. Let's talk about the stock price trend in the last 1 year. From November 2024 to November 2025, the share traded roughly range-bound to slightly up, with a 52-week high around 1,100 on the 25th of July 2025, and a 52-week low near 1,186 on 23rd of January 2025. Current levels in early November 2025 are around the mid-1,300s, a few percent below the 52-week high and above the 52-week low. Dips in January 2025 and again after Q2 FY 2026, results in October 2025 largely reflected macro sentiment, normalization of profit growth, and short-term worries about operating expenses and margins, rather than any structural deterioration in asset quality. Let's talk about promoter buying and pledges. ICICI Bank is professionally managed and does not have a traditional promoter group. Promoter holding is effectively 0%, so there's no promoter buying or pledging. Shareholding is widely distributed among FIIs, mutual funds, insurers, and public shareholders. Let's talk about valuation versus peers on PE. At recent prices near 1,340, 1,370, and FY 2025 EPS in the low 70s, the stock trades around 18 to 19 times trailing earnings. Among large Indian banks, HDFC Bank typically trades in the low 20s on PE, Kotak Mahindra Bank closer to 30 times, Axis Bank in the low teens, IndusInd in the mid-teens, and SBI near 10. ICICI's PE sits between high-quality private peers and lower multiple PSU or turnaround peers, consistent with strong but not scarcity premium positioning. Let's talk about valuation versus peers on price to book. With FY 2025 book value per share around the low 400s and price in the 1300s, PB is roughly 3.0-3.2 times. That is higher than many peers, Axis around 2 times, IndusInd below 2 times, SBI near 1.5 times, and lower than Kotak closer to 4 times. HDFC Bank's PB post-merger has been atypically low given the blending of the mortgage book. Over time, its normalizing ROE may shift that multiple. ICICI's higher PB versus most banks is supported by ROE near the high teens. Let's talk about valuation versus peers on EV to EBITDA. For banks, EV/EBITDA is less standard because deposits are operational liabilities. Treating enterprise value as market cap plus net borrowings and using operating profit as a proxy for EBITDA, ICICI screens around the mid-teens multiple. This aligns broadly with its PE and compares as higher than PSU banks and lower than the most expensive private peers. Directionally, the metric supports a fair to moderately premium read, consistent with quality and returns. Let's talk about variables and risks. Economic cyclicality is rated medium. Banking results track the credit cycle, typically 3 to 5 years. Interest rate risk on funding costs and asset yields is medium. Deposit repricing and repo-linked assets can compress NIM when rates fall. Asset quality risk is low to medium, currently given GNPA and NNPA ratios in low single digits and strong provision buffers. Customer concentration risk is low due to a granular retail base and diversified corporate exposures. Policy and regulatory risk is high because banking is tightly regulated. D-SIB status adds buffers but also obligations. FX risk is low given limited foreign book and hedging. Execution and operational risk is medium. Scale and technology reliance demand strong controls, which the bank continues to invest in. Technology disruption risk is medium as fintechs pressure fees and customer expectations, mitigated by ICICI's digital leadership. Contingent liabilities are low based on disclosures. Seasonality is low while cyclicality is inherent. Promoter pledge risk is none. Let's talk about the latest news in the last 1 to 2 months. On 18th of Oct 2025, Q2 FY 2026 results showed year-on-year profit growth in the low single digits, stable NIM around the low 4% range, continued strong asset quality with net NPA under 0.5%, and higher operating expenses tied to technology and people investments. The market reaction was a short-term dip of a few percentage points. In the same period, product news included incremental enhancements to cards and payments propositions and festive offers aimed at boosting fee income through H2 FY 2025-FY 2026. Let's talk about analyst ratings and reviews. Through 2025, the overwhelming sell-side stance has been positive, with a large majority rating the stock buy or outperform and a minority at hold. Targets in early and mid-2025 clustered around the mid-1500s to mid-1600s. After the October 2025 quarter, many brokers retained positive views, citing consistent execution, superior return metrics, and resilient asset quality, while acknowledging near-term expense growth and potential margin normalization if policy rates decline. Let's talk about which mutual funds hold the stock and the recent trend. Indian mutual funds collectively hold a very large stake, around the low 30s% of equity as of the September 2025 quarter. ICICI Bank is a top 3 position in several flagship funds, with weights often between 7% and 9% of those portfolios. Over the last few quarters, mutual funds have generally added on dips, with occasional small trims for rebalancing when prices rallied. The broad domestic institutional stance remains constructive. Let's talk about FIIs adding or reducing. And the last big move, foreign institutional ownership, is in the mid-40s%. In the June to September 2025 quarter, FIIs trimmed holdings by roughly 1 percentage point, likely reflecting global allocation shifts and profit-taking after strong year-to-date performance into July 2025. The last large swing prior to that occurred across late 2022 outflows and 2023 inflows. Overall, FIIs remain major long-term holders alongside domestic institutions. Let's talk about promoter share contribution. Promoter holding is effectively 0%. The bank is professionally managed, so promoter contribution to shareholding is not applicable, and there are no promoter pledges. Let's talk about government regulation. The bank is regulated by the Reserve Bank of India under the Banking Regulation Act and related norms on capital adequacy, liquidity, provisioning, and governance, and is also subject to SEBI, IRDAI, and other regulators through its group entities. As a D-SIB, it maintains additional capital buffers. Regulation reduces solvency risk but can constrain flexibility and profitability through requirements like CRR, SLR, and priority sector lending. Let's talk about growth outlook from the last 2 investor calls. Management commentary in April 2025 and October 2025 pointed to mid-teens loan growth driven by retail and SME, with corporate growth tracking CapEx visibility. Net interest margin was guided to be broadly stable near current levels in the near term, with some risk of modest compression if repo cuts proceed. Asset quality was expected to remain strong, with benign credit costs, supported by high contingency provisions. ROE guidance implied sustaining the high teens range, with operating leverage from tech and network investments gradually improving the cost-to-income ratio. Let's talk about management guidance for the next 12 to 24 months. Explicit numerical guidance is limited, but the directional guide is clear. Risk-calibrated growth across segments, stable margins in the low 4% range with sensitivity to rate moves, low credit costs thanks to provision buffers, and continued investment in digital ecosystems to grow fee income. The capital position is strong, CET1 and Tier 1 comfortably above requirements, so no equity raise is anticipated for growth over the period. Dividend payout is expected to track profit growth while prioritizing balance sheet strength. Let's talk about the forward order book. As noted, there is no standard order backlog for banks. The internal pipeline indicated by sanctions and corporate utilization, plus ongoing retail demand in mortgages and vehicles, suggests a healthy setup for mid-teens loan growth if macro conditions hold. This is not disclosed in precise numbers. We approximate by triangulating commentary on demand and system credit growth trends. Let's talk about investor playbooks, purely educational, not advice. For holders at a notional 5%, 10%, or 15% loss, one educational approach emphasizes thesis validation over price anchoring. A checklist might include: is the bank maintaining ROE near the high teens? Are GNPA and NNPA stable in low single digits? Is NIM around the guided low 4%? If these data points hold in subsequent quarters, one non-advisory framework is to continue holding through the cycle and consider staggered averaging only within a pre-decided risk budget. If any red flag, such as a sudden surge in NPAs or a multi-quarter slide in NIM below internal guardrails appears, a risk reduction framework could be studied. This is a general framework, not a recommendation. Let's talk about a framework for holders sitting on 5%, 10%, or 15% gains. A non-advisory construct many investors study is a rules-based approach. For example, apply a trailing stop that is wider than normal volatility, say 8-12% below current levels, to protect gains while allowing the position to compound. Another educational construct is partial rebalancing, trimming a small slice when positions exceed target weights, while keeping a core long-term holding. These are general techniques, not advice. Suitability depends on individual risk tolerance and portfolio design. Let's talk about a possible entry framework for new investors. For educational purposes, a dollar cost averaging or staggered entry approach is often studied for quality banks at reasonable valuations. One way to structure this study is: initiate a partial position at prevailing levels if thesis boxes are ticked, ROE in high teens, NNPA under 0.5%, NIM stable, then add on broader market corrections or stock-specific pullbacks toward previously defended support areas, subject to risk limits. Alternately, some study breakout entries above prior highs with predefined risk budgets. Red flags that could invalidate a study plan include a sharp, unexplained deterioration in asset quality, a multi-quarter margin squeeze well beyond policy rate effects, or any governance concern. Again, this is an educational framework rather than a recommendation. Let's wrap with the key takeaways. As of 3rd Nov 2025, ICICI Bank shows multi-year growth in income and operating profit, strong capital and asset quality metrics, and a valuation that sits between sector bellwethers and lower multiple peers, roughly 18 and 19 EMS trailing PE and around 3 EMS PB, supported by ROE near the high teens. The last 12 months saw a 52-week range from 1,186 on the 23rd Jan 2025 to 1,500 on 25th Joel 2025, with current levels in the mid-300s. Risks to watch include policy and rate cycles, execution on technology and expenses, and macro cyclicality. The bank's own guidance emphasizes steady, risk-calibrated growth, stable margins with some rate sensitivity, and low credit costs supported by provision buffers. For educational purposes, investor playbooks often rely on rules-based averaging, trailing stops, or staged entries rather than binary all-in decisions. Please remember, this entire voiceover is strictly informational, not investment advice, and you should consult a licensed professional before acting.